Job openings rise in a sign the US labour market still needs more workers. Welcome to Market Insight. I'm Elena Casas. There were 8.14 million job openings in the US in May, according to the JOLTS survey. That's more than the month before, even though the number was forecast to fall. It points to a labour market that is still in need of workers ahead of this week's non-farm payroll numbers. The US economy is forecast to have added 190,000 jobs in June. That would be significantly down on May's 272,000. Investors are looking for a weakening in the labour market to encourage the Fed to cut rates. But for consumers, it could mean worry about the security of their jobs. Joining me now to talk about the consequences of all that for the market is David Sekera, Chief US Market Strategist at Morningstar. David, hi. What could a weaker labour market then mean for consumer stocks? Are we already seeing a more cautious consumer?
Well, it's interesting. When we look at consumer stocks, especially consumer defensive, we think that they're overvalued at this point. They're trading at about 8% premium above a composite of our fair values. And a large part of that is because I think what we've seen coming out of first quarter earnings is that middle income consumers are really just starting to feel the pressure of 2 years of compounded inflation. And so we're starting to see a pullback in a number of those consumer stocks. Specifically, those stocks where items are either discretionary or maybe even considered indulgent. So looking at the results, companies like Starbucks saw a big decrease, in their foot traffic. Other companies like McDonald's had some relatively weak earnings. And then most recently, Nike certainly had a big miss and that stock went down as well. So I think, this Friday, what we're looking for is, jobs relatively to, ease off a little bit, but not fall all that much. And that really is our base case looking out for the economy, that we're expecting the rate of economic growth to slow over the next couple quarters. Now, actually, our economic outlook for the second quarter, we're looking for about a 1.8% GDP print, which would be higher than the first quarter. But when we look at the numbers underlying the GDP, we think actually activity is probably stronger than the first print actually came out to be. And the second quarter, a lot of those numbers are probably going to be a weaker activity. So we're looking for the rate of economic growth to slow, but we're not looking for a recession. And then we're looking not for the economy to start growing again until the second half of next year.
If the inflation-hit consumer is trading down then, are there stocks that see benefit from that?
Well, we're seeing a number of different stocks that are starting to benefit from that. Walmart stock certainly took a pretty good jump after they reported earnings. However, taking a look at the consumer space, it's hard to find a lot of opportunities other than in like the food category. Now, a lot of the food stocks have lagged over the past year and a half. They've struggled to put through price increases, as fast as their own cost inflation has gone up. But with inflation moderating, we think that those prices will continue to keep rising. They'll get back towards more normalized historical margins. Two stocks that I recommend investors to take a look at are going to be Kraft Heinz. That's probably one of our favorite picks right now in the food sector. It's a 5-star rated stock, trades at a 44% discount to our fair value, and then it pays a 5% yield. So you get paid pretty well while you wait for that one to work. The other stock I'd point out is going to be Kellanova. That's a 4-star rated stock at a 20% discount, pays a 3.7% dividend yield.
Looking at the wider market, David, I know you're sceptical that the rise of AI stocks can continue at the recent pace. Why is that?
Well, there's a number of different factors going on, but it's really all about valuation at the end of the day. So in the short term, just because a stock is already fully valued or overvalued doesn't mean it can't become more fully valued or overvalued. But when I look at our valuations, I just think that the huge gains and outperformance in AI stocks is probably behind us at this point. So I recently ran an attribution analysis on the Morningstar US Market Index. And since the end of 2022, the 7 stocks account for 7% of the market return since then. But when I look at our valuations, we think that they've pretty much run their course. So at the end of December 2022, Meta Platforms and Amazon were both 5-star rated stocks. Amazon right now is a 3-star rated stock, meaning that we think that it's fairly valued. Meta is now a 2-star rated stock, so we think that's now overvalued at this point. Alphabet also was a 5-star rated stock. It's now 3 stars. And even NVIDIA, which was a 4-star stock back then, is pretty fully valued. It's a 3-star stock. In fact, it's probably getting pretty close to 2 stars at this point. And then even looking at Apple, that was a 3-star stock back at the end of 2022. We think that with that recent run up after the developers conference, it's run up too high. It's now a 2-star rated stock. So very cautious with how much more those are going to continue to keep rising over the next couple of quarters. And to be honest, we actually see much better value in the value category than either in the core or growth categories.
Given how much of the recent market rise has been concentrated in those AI stocks, then, if they have run their course, what does that mean for the market?
Well, I think overall we have to look for returns to start broadening out. Specifically, I would look to overweight the value category. That currently trades at a 9% discount to our fair value, and plus I think the value category probably holds up pretty well in a time that we see the economy starting to slow for the next couple of quarters. Now, having said that, when we look by capitalization, small cap stocks still remain, in our view, the most undervalued. It trades at about a 20% discount to fair value. So we are expecting the Fed to start cutting rates, here in September. Historically, when the Fed starts cutting rates, that will be a positive for the small cap category. So that would be one area that I'd look towards, for investors to be able to outperform going forward.
David Sekera of Morningstar, thank you so much for that analysis. Well, that's your market insight. You can watch more videos on Reuters.com.